All right, so welcome to Coffee with Marcus and Mark, the number one stock market show on Spotify and one of the most popular market updates on YouTube. So, in this show, we are going to talk to you about what's happening in the markets and how we are trading it. Today is Thursday, January 5th, and wow, yesterday stocks had a volatile day. They did close higher after a choppy session, but the ISM manufacturing index showed contraction after 30 months of expansion. And then we also had the Fed meeting minutes, and they were really hawkish, meaning that the central bank will remain aggressive to tame inflation. Today, more jobs reports. So, what's happening in the markets? How is it going on? And most importantly, how are we trading these markets? And by the way, if this is your first time here, hi, I'm Markus Heitkoetter. This is my head coach, Mark Hodge, and we're real traders who trade live accounts. So, therefore, we've got a lot of trading experience, and we're showing you how we trade these crazy markets. So, trust me, we know our stuff, and we're not afraid to tell you like it is. So, if you're looking for some honest insights into the fascinating world of trading, you are in the right place. And geez, Mark, we just talked about it with our mastermind members. I mean, markets just can't break out. This Santa Claus rally was just stuck in the snow.
It was the Santa Claus rally was, really a bust. Um, Traders trying to figure out what the heck to do. We're in a tight range. Looking at that chart, just looking at the last couple of weeks, the markets are trying to find some direction. The direction did not come from Santa, and now we're gonna see if it has to do with jobs tomorrow and what the Fed's gonna do. But today was an interesting day, jobs wise.
Yeah, let's talk about jobs. Let me just bring it up here really quick. There we go. So, looking at the economic calendar, we can actually start yesterday. So we had the JOLTS job openings, and they came in better than expected. But then we said, okay, it was November numbers, and this is why the markets were choppy, waiting for the Fed meeting minutes. And then the Fed meeting minutes were released, and that's where basically said, okay, we see higher rates for some time ahead. Basically, what we heard that none of the FOMC members there were dovish, meaning that they were saying, hey, maybe we should stop. Everybody says pedal to the metal.
And this is where I think that is wise of the Fed. Even though it looks like we might have seen peak inflation and things are looking better on the inflation front, we still have a strong jobs market, and that's not what the Fed wants. So for them to be strong with their wording, I think that that's important. And of course, they are looking at all sorts of data points prior to the February meeting where they'll decide on whether or not they raise interest rates by a quarter or a half of a point. But I mean, gosh, they should be strong with their wording.
Yeah, and I mean, they basically reemphasized yesterday, okay, we got it. Goods are coming down. So, I mean, we talked about it this morning. We can actually look at some charts here together. Because if you look, for example, at lumber, which has skyrocketed last year, so lumber costs, as we can see, have come dramatically down. Copper, which is used a lot in industry and production, so copper prices have come down. We already know that crude oil prices have come down, which is all part of inflation. So from the peak that we had earlier at what, like 120, $130, we're now at $73. We have even wheat, soy, all of these have come down from the highs that we had earlier this year. So all of this is good. It's moving in the right direction. The housing market is also cooling down. All good. But labor cost, that is the one thing that the Fed is fighting right now. They said, okay, we got to bring the labor cost down. How do you do this? Well, this is where you need a softer labor market, right?
Yeah. Yeah, when you have fewer people looking for jobs than the jobs that are available, it keeps the salaries higher, and it means that there are jobs available to be taken, which means people have money to be spending, and that's not what the Fed wants. So it's kind of a good news is bad news scenario because you would think that a strong jobs market is great, and in general, when inflation is down, the Fed loves that.
Yeah. And then, so we had more jobs data tomorrow, again, ahead of the big one tomorrow. So this morning we had a few. We had the ADP non-farm employment change coming in better than expected. And 15 minutes later, the unemployment claims also lower than expected. So all of this shows that the jobs market is still strong.
Yeah, and that ADP private payrolls, I mean, that coming in at 235. You see the forecast. Yeah, this was a surprise for sure.
Yeah. And this when, yeah, it surged by 235,000. So that's kind of crazy. And this is where we see this morning. I mean, until yesterday, traders were thinking, that the Fed, they're kind of bluffing and everything is okay. So traders were anticipating for the next meeting a half a percent, a quarter percentage point hike. But
Yep.
this has changed. I mean, right now it's almost 50-50 for a quarter percent on the left and half a percentage point on the right.
Sure. And we still have the jobs report tomorrow, which is a more significant report. It's a report that traders put more emphasis on versus this non-farm private payrolls number. But that surprise is what changed the probabilities. Traders that caught traders off guard for sure.
Right. So a week ago, we were still at a 73% probability of a quarter percent hike. And right now, it's only 56%. So definitely coming down. And also, we talked about it yesterday, the probabilities, because the Fed keeps saying, we think that the final rate will be at 5.1 to 5.4%. And traders said, nah, you're kidding. Until right now, it has tipped. Now, traders seem to start to believe with this stronger job market that the Fed will keep raising interest rates. So, very interesting developments here today.
Yeah, there was that disconnect between what the Fed has been saying and what traders were expecting based on these Fed funds futures and the probabilities. But it does look like even though now traders are factoring a little bit of a higher increase, that things will calm down a little bit sooner and you might get a cut in September, where before that was November, maybe the December meeting where they start cutting rates.
Yeah. So, I mean, we will see. And we also know that the data is delayed. And if you look at the news, then we know that yesterday, Salesforce said it's cutting about 10% of employees and closing offices. Then last night, Amazon was following and say that they will cut 18,000 jobs. And previously, they said probably 10,000 jobs. So we are hearing from more and more companies right now who are laying off. So it seems that what the Fed is doing is working, but is not reflected in the numbers just yet. We
Yeah,
also need to
Stitch
say,
Fix.
sorry, go ahead.
Stitch Fix also, they just announced that they're going to cut 20% of its salaried workforce.
Yeah. So let's see. Amazon, I just looked it up. I mean, they have hired so massively. So this here, a graph provided by Bloomberg, that's barely making a dent. If we see what happened here over 2020 and 2021, so we'll see. This has to get much, much, much softer. Yeah, but with the jobs, a jobs report coming out tomorrow, that's what traders are waiting for right now. So back to the indices. Today, if you look at a 5-minute chart here, in the S&P, we opened lower after the jobs have been released, and we're still diddling around in this tight range here.
You know, it is interesting because markets are down over 1%, but you're right, Marcus. If you look at where we've been trading over the last week, maybe 2 weeks, it's not that significant, right? We're just right in this range. So even though for the day it feels like, oh, we're down 1%, we're not moving in the right direction, or at least the direction most traders want the markets to move in 2023. We're just in this range, which isn't a significant move lower.
Yeah, and investors just don't want to commit money to the markets just yet. I mean, we said that in the S&P over the next few weeks, it will be the battle around the 200-day moving average and the 4,000 line. Completely different story for the Nasdaq. For the Nasdaq, it will be a story: will the Nasdaq make new lows, or will this level hold here that has been established pretty much in October, the lows here, or will we
I
take
saw
those out?
I saw an article that said the Tuesday to Tuesday, so Tuesday after Christmas, going into Tuesday of this week, that retail traders went on a dumping spree. They dumped $4.1 billion in stocks. They picked up some ETFs, buying 630 million in ETFs, 400 million in fixed income ETFs. But Tesla being one of the most sold by retail traders last week. And Tesla, as of yesterday's close, down 70% from its all-time high.
Yeah, Tesla just can't catch a break. We talked about this yesterday. It's just Elon Musk's focus has shifted. They did not have as many deliveries as analysts expected, and this is why it's still sliding. And Tesla, everybody's darling, because if we look back, I mean, this is where Tesla, you could just enter at any time and you made money, right?
Yeah.
But now, definitely strong headwinds ahead of Tesla. And this is definitely a retail trader's darling, but no more.
No more. I saw Elon Musk tweeted yesterday, a year ago, I was man of the year. How times have changed. And for him, needing to sell Tesla stock, the worst. I mean, that's just, contributing to this move lower, right? Retail traders losing confidence, but also all of the stock that he had to sell not helping matters.
Right. So also, what does it mean for us and for our trading? Well, we still have our positions that we are in. Nothing to do right now. We talked about it yesterday. We can take a very brief look. So CTRA had a really good run yesterday. We got a sign at 26. Right now, it's trading at 23.80. So right now, not in call selling territory. Google, same. My break even at 104.28 today, with the overall market lower again. Nothing here to do just yet. Nvidia, very similar here, also just trading in this range. My cost basis at 160.91. My break even at 137 here. So trading between my break even and cost basis, nothing to do there. But then with the down day today, Mark, we had quite a lot of candidates popping up on the scanner. So what do you think about some of them? For example, AXP. Let's take a look at AXP.
Yeah, I like the chart of American Express. We see that, sure, we've shifted into this range compared to what we had at the end of 2021, beginning of 2022, but nice range. So this is the type of chart that I like for the wheel. I would ideally look for a lower strike. And to be honest, Marcus, we talked about it with our mastermind group. With the jobs report tomorrow, this could be significant, right? Um, I think it makes sense to have some dry powder. If there is a big drop, then we can look to put on positions after that move where we'll get better premium and lower strike prices. If there's a little bit of a rally, then we'll see what else we could pick up in the next couple of days.
Right. But American Express, definitely an interesting candidate. And then to stay in the group of the financials, DFS also looking quite interesting, the chart, right? And
Yeah,
the financials are also looking good.
agreed.
And then, I mean, we have already traded Williams Sonoma. So that's another one that popped up here as a possibility. Chart looks good. Financials looks good. So, I mean,
Sure.
today, definitely with the markets down, we see that we have 23 symbols that are popping up, and quite a few are possibility. But as said, I mean, why wasting your gunpowder today if there's still a battle to fight tomorrow?
Good point.
Yeah. So tomorrow really the big one before the markets open at 8:30 Eastern time. So 1 hour before the markets open, we have the jobs report, and so the unemployment rate is expected to stay at 3.7%. But then the average hourly earnings, the increase month over month, is expected to go down to 0.4%. Last month it was 0.6%, and that's what we said, right? I mean, always think about this, multiplying it by 12. So this would be, I mean, I'm not saying the inflation is 4.8, but this will be an increase of 4.8 this year, much higher. So we need to be, especially with the average hourly earnings, meet expectations or even be lower at 0.3. That would be good for the markets. And that's what the Fed wants to see.
Sure. I mean, tomorrow the unemployment rate really doesn't matter, right? It's all about non-farm employment numbers. Do we get a big surprise like we did with private payrolls, and then our average hourly earnings staying strong or increasing? That would not be what the markets want to see.
Yeah. And again, so tomorrow will be super interesting. Tomorrow we probably find a lot of opportunities to take new trades. And we have a few positions open here in our portfolio. So there's definitely something to see. But by the way, do you find this helpful as we are breaking it down and show you a few trades that you could consider here? If so, give us a like. And if you would like to learn more about the way how we trade these markets, we link to a couple of videos here. This way you get a feel of what we are doing. So check these out, leave a like, and then we'll see you again tomorrow.
Happy trading, everybody.